Hey everyone, it's Mayhem Talking Markets, Sunday, December 26th. Hope you and yours had a Merry Christmas and Happy Holiday break. Whatever you celebrate, I hope it's been a refreshing break from the markets. While we did close last week on a good note, it started off on a rather sour note, and I'm sure it's been choppy sailing for folks out there that have been in long land. If you've been trading, the volatility's been nice. And it seems like we're set for some more interesting days ahead as it's still a somewhat illiquid and potentially volatile market. So we're going to look at S&P 500 in just a couple different time frames here. We're going to start off with actually a monthly time frame. So this goes back to the end of 2006. That was the peak of the market up to 2007. We saw the great financial crisis follow, right? So really we had this peak in 2007. The fall ended up being the beginning of the end for that bull market. There was some hope that maybe the Fed was getting it under control, and we really saw things start to spiral out of control here. But looking at this chart from a Ichimoku cloud, volume by price, and full stochastics technical analysis perspective, we're using all three indicators. Once again, the monthly time frame. So each candle represents 1 month of price action. And essentially what you can see here is the Tenkan is this sort of orange-brown line. The Kijun, so that's the leading indicator. The Kijun being the lagging indicator is this blue line here. You can see both of them tend to provide some price interaction, some areas of support, and potentially resistance, depending on what the market's direction is. So there's a lot of interaction with these on multiple time frames. The reason I mention that is for an indicator to really seem to be valid, there really needs to be a lot of price interaction with them, showing them as resistance, as support, as areas where there's some kind of interaction on multiple time frames. So that's one reason that I do like these indicators, because we see that consistent theme that with the Tenkan and the Kijun and the cloud itself, there's a lot of price interaction. So we could see that when prices moved below, first into the cloud, right? So becoming trendless on this monthly close here in 2008, then breaking into a monthly downtrend on this cloud, close below the cloud here, and then further selling into the final crescendo of selling in March of 2009, which was that 666 low on the S&P, and then eventually the month reversed higher, and that was when we saw both a sizable intervention in Fed policy. I believe that was the first iteration of QE, combined with FASB suspending mark-to-market and implementing mark-to-make-believe for financial institutions, so that all these mortgage-backed securities and other assets that were essentially worth nothing could be marked up as 100 cents on the dollar or 50 cents on the dollar, and balance sheets looked a lot better, and so confidence was restored and everything was right. But what was really interesting to see, of course, is that once we got back above that monthly cloud, which happened in late 2010, I believe it was the last month, December, they had that close above the monthly cloud. We were grinding through a lot of supply here. You look at all that volume. Some of the folks, who have been trapped there may have been eager to get out. You certainly saw the selling wave follow as we got into this area. But also, we saw that we broke above the cloud, and from that point on, and even to this day, we've never had a closing monthly candle below the Ichimoku cloud. We also saw leading into this period where we were breaking above the cloud, but there's also a bearish cloud twist, which might have been one of those foreboding indicators that, yes, there was still a little bit more difficulty yet to come. Now, we also see the cloud shape here being flat, providing some support to price action here. So that was really interesting. As we could see that with these indicators, as I mentioned, I like to see price interactivity. We certainly saw plenty of that. And then as we moved up, you could see that there was interaction with the Kijun, there was interaction with the Tenkan, as you can see here, here, and then with the Kijun here, and the Tenkan again, here, and here, and here, and then again with the Kijun. So we really had a lot of interaction with those leading and lagging indicators, but we didn't have an interaction with the cloud until March of 2020, right? And that was something that was really interesting to see as well, because we did not have a monthly close below the cloud again. In fact, the cloud started to act as support. We had that bounce again, and then we haven't revisited it since. So on a monthly basis, everything is pretty healthy. We're still in a uptrend. You saw the November cloud look like a hammer can. I'm sorry, the November candle looked like a hammer candle, and that ended up being sort of a false indicator. Obviously candles don't tell the future, or everyone can look at the last candle to know what the next one would be, but they do sometimes portend to probabilities. And for the bulls, thankfully, December actually ended up being the opposite. So far, at least, we've been above those November lows in terms of where we are right now. We're well above those November lows. We tested lower lows. We actually tested October levels, but we were able to manage to get above those. And so, this candle so far, this monthly candle that represents really just the last 30 days of price action, so it doesn't really become valid until the close of the month. But nevertheless, it's a bullish looking candle, and it did negate the bearishness of the November candle, or at least the prior 30-day candle. So we're going to move on to a weekly time frame here. On a weekly time frame, we're going back. You can see that we have some of 2018 here. This is the 2018 quantitative tightening temper tantrum, I guess you could say. So we had that price action on a weekly basis move below the cloud, and that means on a weekly time frame prices were in a downtrend. And we saw those prices move back above the cloud, but not without some consolidation. As we saw here, there was some uncertainty, a couple weeks of just kind of thinking about it, grinding higher, but still candles that represented a lot of volatility within. And for market participants, less than certain price trending. If you're looking at things on a day-by-day basis, you're seeing a lot of prices move up, move down, move up, move down, not necessarily give you an idea of direction, a lot of false starts. But ultimately, you did see candles making higher lows, which was constructive. Not every candle made a higher high, but they were making higher lows, so at least you had some sense that prices were, moving in the right direction, if not necessarily giving you a clear uptrend with the higher highs on a closing basis as well. You could also see the top of the cloud acted as resistance, just as the bottom of the cloud had acted as support. So that's something to keep an eye on. Another trader friend of mine, Nova Wave, says keep an eye on the shape of the cloud. That's also another indication to be mindful of. So on a weekly basis, we've had multiple tests of the cloud. The test that happened later in 2019 ended up just being a brief test, really didn't break below the cloud meaningfully. And then we had, of course, 2020, where we not only broke into the cloud but below it, and for several weeks. And so we were in a downtrend, and that was about as long as the downtrend that we had in 2018. And in some ways kind of similar in the price action, just much more extreme, right? But this was a pretty severe correction. It wasn't a new bear market. I think the bull market we're in now, and as we saw on the monthly chart, we haven't really been in a downtrend since. This bull market started in probably 2009, 2010, and it's really been going since. So we broke above the cloud, and since then, after the COVID correction, we have not broken below, and we've been most of the time above the Tenkan. But there's been situations where we've tested the Tenkan, and there's been situations where we've tested the Kijun most recently. And then again testing the Tenkan. So we've been in this constructive uptrend. We've had some noise and some selling and some distribution, but for the most part, it's been a pretty solid uptrend. There's been minimal drawdowns. There really hasn't been any drawdowns over 5% or 6% in 2021. So it's been a pretty mild year at the index level, though that hides a lot of the underlying price action, because at the index level, you're not seeing what's happening because they're market cap weighted to all of the components below, with the S&P being about 25% represented by 5 companies, and the NASDAQ being 40% represented by 5 companies. So that doesn't, the price action at the index level doesn't always tell you, unless you're looking at the equal weighted indices, what's going on underneath. So that's one thing to keep in mind. Like with the NASDAQ composite, only about 30% of the stocks are above their respective 200-day moving averages. So, it's not necessarily healthy in terms of the breadth of participation to the upside. But that doesn't necessarily mean that we're heading towards some kind of calamity. It just means there's less stocks participating. That means also there's less potentially extended valuations within because there's less stocks moving to the upside. So it is something to keep an eye on. We do, if we're bullish, want to see that participation above the 200-day and above the 50-day and making new highs and so forth improve, especially as price action improves. So we want to see a coalescence between breadth and upward price action to really illustrate a healthy late stage bull market. So now we're going to go, because we can see on the weekly, time frame, we've been in this pretty solid uptrend, especially since, the COVID correction ended on a weekly time frame. So now we're just going to look at the daily time frame here, and we can see that it's a similar picture. We're going to zoom this out a little bit more so we see all of 2021 here, and we can see 2021 started here. We had that March route. It tested the cloud, right? We had the September-October route. We tested the cloud. We broke below it. We actually had a couple of daily closes below the cloud. So in that period of time, for this close here, that was a downtrend warning, as was this one, as was this one and this one. So those are some warnings that the trend was getting unstable. We were able to break above. We were able to get back into positive territory. And then we had another kind of test run here in December, but that didn't last more than a day, and it wasn't a close below the cloud. It was a close within the cloud to become trendless rather than downward trending. And remember, when I'm looking at this Ichimoku, it is weighted on cash price action, open and close. So, I know that, some other folks will use Ichimoku with a sort of futures price action weighted in there, and that can give you a little bit of a different indicator in terms of where some of these levels are. And, your mileage may vary. I think both indicators are valid, but they also have different purposes. If you're just trading SPY or you're just trading during regular hours, this is probably more than enough. If you're trading futures and you're trading overnight, you might want to have the indicators that are going to include all of that price action in their levels and their weighting. So just something to keep in mind. But on a daily time frame, things remain healthy. We are in an area of potential distribution here, though. There's a lot of buyers up here. So, folks that got trapped up here or up here might want a second chance to sell. We have seen a lot of selling as we get up to these levels, so it's really going to be key what we see going into next week, the last trading week of December, as to how things end up closing. I believe the last trading day, Friday, is the 31st. So really, we have the last days of December as the last trading days. And that's going to make us 5 more candles on this daily chart and 1 more weekly candle, and then close out that monthly candle. So it's going to be pretty important to see how we close on Friday for a lot of different reasons. And it kind of sets the tone for how we might start January with those beginning of month, beginning of quarter, and beginning of year flows coming into the market, which are typically constructive, as long as the market's in a kind of a positive technical place. That'll help those flows really push prices higher. So, we're in an uptrend. Everything looks healthy overall. I know we had a close call recently, and we had a close call before, and there was a lot of cries for Armageddon really starting here when everyone started to get quite nervous out there. I shouldn't say everyone, but a lot of folks got nervous, and then the bears started growling and saying it was the end of the world, posting their dot-com bust and 1987 crash and all these other parallel charts about how this is the same thing over again. But remember, past isn't prologue. Eventually, this bull market does come to an end, and it probably will be an unceremonious end, and it could happen in, any time. But right now, from a technical standpoint, things seem pretty solid. From an earnings standpoint, we still see good growth going forward into 2022, and the economy is probably set to slow a little bit, but it's going to continue growing. So we'll probably have some more bull market price action to eke out of the S&P 500, the NASDAQ, and maybe we'll see some broader participation. There's a lot of consternation about what's going on at the macro level with the Fed. I personally don't think that putting the brakes on QE the way that they have is going to derail this bull market, but I do think it may change the preference of where fund allocation goes, and that's something we'll talk about in a future video about full cycle investing and what that means for, our portfolios. But for now, this is Mayhem. I'm signing off. Hope you all have a great week ahead, and we'll be dropping another video here for everyone shortly. Hopefully, we'll also get some guests on that can talk what they're looking at. We can have some of the graphs and charts and data that they're seeing, so we can discuss that as we move forward. But hope everyone has a great week ahead, and look forward to interacting with you all on YouTube and Twitter and elsewhere. And don't forget to subscribe and like if you enjoyed this video. Check me out on Twitter. The handle is Mayhem number 4 Markets, Mayhem 4 Markets, and check out my website, marketsandmayhem.com.